Well, both the Bank of Canada and the Fed met on consecutive days, which gave us a huge signal as to what we can expect in the coming months and this year. And I think it's actually what no one really expected, which is where things are going to get really interesting. Briefly, as we know, the BOC held rates at 4.75% on Wednesday, but they dropped some hints about future cuts and what might happen there. The Fed held rates at 4.375%, with Jerome Powell basically killing any September rate cut hopes. But the plot twist here is that the Canadian bond yields, which, as we know, connect with fixed interest rates, stayed basically completely flat despite the BOC's dovish tone. And now this really tells us that the markets are essentially tracking more US policy than Canadian policy. And if you've been listening to my podcast for a while, you know about the correlation between the US markets and the Canadian rate markets. And that, my friends, is what you don't expect. And let's break down exactly what this means for you. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow. So I spent just a few nights going through a couple of different articles and breaking down the Fed statement line by line, and I found a number of specific things that directly impact Canadian mortgage rates and real estate. Some of this stuff nobody is even talking about. Now, some of this information came from an article from my friend Rob McLister, but I did take some details and change based on my opinion and what I think is actually going to happen in the marketplace. By the end of this, you'll understand why Canadian fixed rates might actually be stuck higher for longer. We've talked about this before, why variable rates could surprise absolutely everyone, and which specific economic data points that'll give you a 30-day head start on some big moves. If you're listening to this podcast, you know already I try to stay on top of the data to give you real information and not just conjecture that's available in the marketplace. So let's get right into breaking down the 8 takeaways that matter to you as a Canadian real estate enthusiast or mortgage holder or someone in the industry. Number 1, if you don't already know, obviously the Fed is the US equivalent of the Canadian BOC, and they held steady with their next upcoming rate hike or rate drop going to be in September of 2025. So here's what happened. They held rates at 4.375 despite the insane pressure from Trump. But the interesting thing is that Jerome Powell's language completely killed the idea of any September rate drop hopes, which is what the market's been waiting for a long time. And this big old guy named Trump down there has been screaming and yelling that he's going to basically take away jobs if this doesn't happen anytime soon. Now, here's the connection in Canada that most people didn't see coming. Number 1, Canadian bond yields stayed completely flat after our announcement, but they tracked higher after Powell spoke, which basically means that our market is tracking the US market more than the Canadian market. That's absolutely insane. Our fixed mortgage rates are tied more closely to the Fed policy than the BOC. Very strange stuff here. And what this means for you is that with a 5-year fixed rate mortgage currently sitting just around 4% for the best available market rates, and most of them being about 0.25% higher, they're not dropping meaningfully until the US Fed moves. And at this point right now, the chances of that happening are virtually nothing. Even if the BOC cuts rates in September, your fixed rate mortgage might not move, and it might actually go up. So the bond markets right now, that if you've been paying attention to, are pricing in less aggressive easing from both sides. What this basically means is that the market's forecasting rates not to go down and possibly actually go up. Now, Powell's exact words were the following: inflation is somewhat elevated and further from our goal than our employment. Now, what the impact of that on Canada was that the BOC claims our underlying inflation is 2.5%, but their own preferred indicator that they watch when they say that they're making their decisions is currently at 3.05%, which means even our central bank can't even agree with what inflation even is. So you've got the Canadian bank, the Bank of Canada, that is set to use our monetary policy to stop inflation from getting rampant in Canada, and they don't even know which number that they're even following. Things are getting a little bit crazy. Now, the real impact on real estate is this. If we see persistent inflation, rates stay higher longer. Higher interest rates means rental demand can increase. People can't buy as much, and they must end up renting. That's one thing. Obviously, this has an impact on people's ability to have affordability in the marketplace and how much they can qualify for, which means potentially less upwards pressure. But interestingly enough, if we hold more renters in the marketplace, this could mean the opposite effect in the rental market of what we've seen in the last year, which is instead of seeing rental rates dive, we can actually see rental rates pick back up, which means we could see the yields on rental properties for those investors who have been paying for the last 2.5 years actually be less scary, and rental property ownership becomes a little bit less scary looking forward. Now, the reality check here is that in Toronto and Vancouver, you need $200,000 as a family to be able to own the average detached home. And that's just like a starting point. In Calgary and Edmonton, $80,000 to $100,000 can get you into the market, and crazy enough, even into potentially a single family detached home on the outskirts. No, we're not talking like the dream house or anything of that nature, but you can get into the marketplace, which is pretty wild. So if you're trying to understand what's happening in both markets and regionally speaking, where to look, follow the affordability. I mean, people are flocking from all over the country and immigrating directly to Calgary and Edmonton, and that is the market that is not getting beat up based on what's happening right now. Now, takeaway number 3 is that the labor market is not weakening right now. Powell said that U.S. unemployment is currently sitting at 4.1%, and he called that in balance right now. In Canada, completely different story. We're seeing some softening in the metro market, specifically in the tech sector, as we're starting to see the impact of AI and real layoffs, along with the marketplace just generally not doing as well. We're also seeing the impact of immigration with 400,000 new residents annually, and we thought we were cutting back on that, still needing housing. So from an investment perspective, what we need to be looking at here is, we've talked about this before, where you should be looking in real estate is where jobs are and where demand grows. If you look at the employment data right now, Calgary's energy sector is up 12% year over year. Whereas if you look at a place like Toronto, tech layoffs are creating a rental inventory in the 3,000 plus range, which is pretty wild. The real opportunity in this case is markets that have a high level of employment. And so just to circle back right here, for takeaway number 3, following the labor market is what you want to look at when it comes to the real estate market. Meaning, if you see more jobs and more employment, you're also going to see a higher amount of real estate pressure and rental pressure. So from an investment perspective, that is a place that you want to look. Now, number 4 is that the market cut odds fell after Powell's press conference. This is very important. The U.S. Treasury rose. September cut odds basically are 50-50 right now, which basically means in the U.S., chances of them cutting rates are only 50% right now, when we thought it was a sure thing at the start of the year. When I say we, I mean the marketplace. Now, what happens in Canada, first and foremost, go back. Canadian fixed rates, they get a boost. They're going to go up. Bond yields, they moved in tandem with the US. And the forward market, which is basically where rates are going, they show a less aggressive easing path, which means a likelier higher path to increasing interest rates. That ain't good. So that 4% interest rate that we saw on the 5-year fix for a high ratio mortgage just a few weeks ago, that might be 4.1 by the end of next week, 4.2 by the end of the next 2 weeks or 3 weeks. And variable interest rates, currently sitting there at anywhere between 3.95 to 4.45, depending on if it's high ratio or uninsured. Those are more likely to drop than fixed rates. And that's not saying much, because the variable rate market right now is not looking that good when it comes to the potential of variable rates to come down, which is really interesting, because the variable market, even with the chances that those rates are not guaranteed to come down, is actually starting to look a little bit more attractive in some different ways. So if you're wondering, based on that feedback, takeaway number 4, what does this mean for you as a mortgage holder? Number 1, if you're rate sensitive, variable rates, they might outperform over the next 18 months. So over the short term, they could outperform. If you're in the situation where you might not be living the property long, or you're just trying to figure out how to get in the market and save money, there's an opportunity. If you are looking for cost certainty right now, you are most definitely looking to lock into interest rates before they rise. And we've talked about this many times in many episodes around the renewal market. There's obviously no guarantees, but if the market is forecasting this moving forward, you kind of want to lock in an interest rate before you can, if you're worried about the fixed rate rising market. And that's the thing, is if you're potentially refinancing, if you're potentially coming up for renewal, you can get out of early and then weigh the pros and cons. If rates were to go up by a certain percentage, did it make more sense for you to lock in today or wait till the end of the term to do that? Now, takeaway number 5, this is interesting. So the Fed is an amalgamation of different members. Just like BOC, there's people on the committee, and 2 of the members wanted rate cuts, but the majority of them actually held firm. And this matters to us in Canada because when there's any type of policy uncertainty, it creates market volatility, which is why we saw the rate market go up as opposed to staying flat. Whereas the Canadian policymakers, they might want to hold back to avoid currency divergence, meaning the Canadian dollar getting beat up any further. This is creating a whole series of other issues. And it also means that we're starting to see bond market confusion with wider spreads between the lenders depending on where they're getting their money from. Basically, in English, what this means is that we're starting to see a wider spread between different banks and different lenders on what rates they're willing to offer because we're starting to see this divergence in the marketplace. And it's really starting to cause some confusion among borrowers who are trying to understand why rates are so different in different places. And basically, what this means as a borrower is that you should be in a position right now where if you are trying to qualify for a mortgage, you need to work with ideally a broker who can shop different lender options and show you the difference, because in many circumstances, one lender could have a interest rate variability of 0.25% compared to another one, purely because of the fact of how they believe the market is turning right now. Ultimately, there are a lot of different ways that you can look in the marketplace, but don't lean on only the big banks. In fact, for the first time in honestly what seems like years, we're seeing non-bank lenders offer better terms than traditional banks when they're trying to be competitive. Now, this, historically speaking, the banks have always priced higher, advertised. But what we've seen is that in the last couple of years, they've been competitive on discounts afterwards. We're not seeing that same thing right now in the second half of 2025, which means the marketplace is shifting. And the question is that going to continue? Now, takeaway number 6 is that uncertainty in the marketplace remain highly elevated, which the Fed basically ditched the uncertainty diminished, and now it says it remains elevated. From a translation perspective, what this means for you is that data dependent policy is equal to a volatile rate environment. That's a lot. Data dependent policy is equal to a volatile rate environment, meaning we could see the rate market really move up and down in a quick number. I mean, when I'm talking to people right now, I'm explaining the fact that I see rates going up and down literally on the daily and weekly basis right now, and it's not something we've seen for quite some time. This means the market is less predictable, which makes it harder to make decisions. So you have to rely on the fundamentals when making a mortgage decision. Both of the central banks have this wait and see approach right now, and the markets, they're not waiting. The banks are basically moving in tandem, meaning not the central banks, but the actual big banks. And that's creating a large amount of volatility, which is why you're seeing the rate market change so quickly right now. Now, from a response perspective, the thing is that I believe that having a scenario modeling is key, meaning if you're working with a professional, ideally they build out a model where you can understand on a weekly basis, based on what's happening in marketplaces, the likelihood of option A, B, or C costing you more money than the alternative. So, like right now, just with a standard qualified borrower on a $300,000 loan, you would save the most amount of interest on a 5-year fix, assuming you don't plan on exiting that loan throughout the term. But let's be honest, most people don't ever plan on it. But that's where the market would be today. You also, obviously, as you know, need to be considering things like flexibility in the marketplace and so forth. The current, like I said, forecast curve shows variable 3-year and 5-year fixed are very, very close right now. So it really comes down to an understanding of which one is going to be the best option if rates were to go up or down by, let's say, 1% or 2%. Number 5, the tariffs are fueling near-term inflation. And there's a big question about the tariffs pushing up prices on some categories. And it can take multiple quarters for this to have an impact in the marketplace, which is another reason that BOC held pat, basically giving us 3 options. They go up, they go down, or they stay the same. The implications in the Canadian market are insanely obvious right now. Construction costs are rising, which is impacting lumber, steel, and concrete across the board. Housing supply constraints are real. Now we see building costs going up and permits down. In fact, in Vancouver, just in the last week or two, they were lobbying to look into the possibility of bringing foreign buyers and investors back in the marketplace to try and pump some energy back in the market. You're crazy to think that this is not going to have a real impact in the marketplace in the next couple of years. And if you think that's the case, you're definitely missing something. We're also starting to see that rental demand is increasing. And although the new construction is helping out in some cities with this, meaning new constructions that are going to complete with investors closing on them, it won't keep up forever. And there is going to be a tipping point somewhere in the next couple of years where the marketplace falls over and we run into a supply deficit all over again. From a investment opportunity perspective, I think the thing is you got to look at where the employment is and look at the marketplace that's going to be available in the next 2 to 3 years and consider to yourself where you want to be from an investment standpoint in 2 years or 3 years when the market shifts. Now, takeaway number 8, and this is the big one here. The Fed has said consistently they need more data. They need a good amount of data before they make their next move, no matter how many times Trump screams at Twitter and yells and calls Jerome idiot and all sorts of crazy names. There's a couple of data points that matter. Number one, job reports, which is there's 2 more coming up before September of 2025, and there's 2 more inflation reports. In the Canadian equivalent, we see the employment stats coming out in September 6th and the CPI coming out in September. A lot of data. Basically, short version, there is a ton of data to come out before this next rate cut announcement or rate announcement from the BOC and from the Fed. And in both circumstances, there's a ton of information they're going to be able to use to make those decisions. Basically, short version, a lot of data coming up. We're going to find out how bad these tariffs are and what they really could mean on the Canadian marketplace. But the thing is, if you're not watching the yields and you're not paying attention to the marketplace, because, well, why would you on a regular basis? You could probably miss out, and it's going to cost you a bunch of money. Now, flipping over to the BOC, finally, the Canadian equivalent of the Fed, if you will, here's what Mecklem actually said. If a weakening economy puts further downward pressure on inflation, there may be need for a reduction. He did not say will. It's a conditional thing, not a committed thing. Basically, we may drop rates if this happens, which means that if we see a weakening economy, they basically need bad news to cut the interest rates, right? And if we see further downward pressure, it means basically inflation needs to fall down. So a weaker economy plus inflation coming down is the only way that the BOC is going to start cutting rates. The BOC claims underlying inflation is 2.5%, but the data shows 3.05. It blows my mind that even the BOC has no freaking idea what the data is right now, which means variable rate cuts are possible if the economy weakens. Fixed rates are more dependent on what's happening in the US. So if you're a fixed rate mortgage person, you're watching in the US to see what happens down there. If you have any uncertainty around, because of all the policies uncertainty, it's having an impact on what lenders are offering what interest rates, which basically means that your bank or your lender is probably not offering you the best terms for the product that you're looking for, which is another reason to work with a broker so you don't have to run around and do this all yourself. But I will make one caveat to all this information, which is that the forward markets that we look at to try and predict what could happen, there's no certainty to it. It's like a probability weighted scenario with variable rates giving you a slight advantage over the next 18 months. 3-year fixed is kind of like a compromise between the flexibility and the certainty. And the 5-year is the one that on paper saves the most money if rates were to go up unexpectedly, which could happen. Another factor here is that there's a lot of regional factors to consider when it comes to the real estate market. And so I do want to leave you with what to do right now in this marketplace. If you're buying or if you're selling, number one, if you're buying in this market and you believe the information news that's out there, I wouldn't wait for the clarity from the BOC or the Fed. This could be months. I would consider variable only if you can handle rate fluctuations, because it really could go one way or the other. And the truth of the matter is, in this type of a market perspective, when you're a buyer, you need to be looking at what market strategy that you're buying in. And obviously, if you're buying in the area where you live, then you need to be looking more regionally than ever before. To take Canadian real estate data and use that for any kind of metric is useless right now. In fact, one city, one town, one square block could be different than the next right now. And I've never seen a situation where different products in different cities and different towns and different regions have been so all over the place. But I will say a few things. Number one, you can pretty much negotiate almost anything in most places if you're a buyer, which you should. And the second thing is you don't need to waive inspections or anything and do financing in 3 days like you had to before. You can get proper diligence with 7 days and 10 days, so do that. Now, if you're a seller in this market, here's the thing. You got to price sharp. There's higher rates means fewer buyers, and you have to price things accordingly. Plus, you have to look at your neighborhood and ask yourself, do I have 4 neighbors on my block selling the exact same product? Calgary is not the same as the Toronto market. So depending on when you're selling, you need to be really, really clear on what you're doing and what you're looking for. If you're an investor in this market trying to make sense of what's going on, the math doesn't almost make sense. Higher rates do equal higher rental yields in some ways because you're seeing less people enter the marketplace, but not in others, and the actual yields could be lower. So you have to be clear on that. the supply constraints over the next couple of years can impact the rental market in a positive way. And there's a very good chance that we will see the rental demand continue to be strong as it is right now and actually increase over the course of the next 2 to 3 years. There are some incredible opportunities depending on where you're looking in Canada right now. And I will say, for anybody who says real estate investing is dead, you don't know where to look and you don't know what you're looking for, is my feedback on that. Lastly, if you are someone in the marketplace and you're looking to refinance, it makes sense only if you're saving 0.75 to 1% on the rate, if you're doing it only from a purely interest rate perspective, when you factor in the fees, the penalties, legals, and all that kind of fun stuff. But I will say this is we've seen more people get ahead of the marketplace and save hundreds of dollars, if not thousands in some cases, of cash flow every single month purely by restructuring the loans right now and trying to get ahead of where things could go. So there is a lot of value in doing that. Now, from a conclusionary perspective, to understand what all this data means, the signals, the market insights, and what to watch for, here's what I would be looking forward. Number one, the Fed gave us 8 clear signals. There's uncertainty is kind of like the new certainty. The BSC, well, the BOC kind of showed their hand, and the bond markets responded to the US rate market, which means that's where you should be following when you're trying to understand where the fixed rate market is going. What I would say for the Canadian consumer and borrower is to stop crying to the central bankers, including Trump at this point. They admitted they don't even know what they're doing. You need to start focusing on fundamentals if you're getting into the real estate market, knowing where the jobs are, knowing where the supply is, understanding the economics of different scenarios, and stop speculating in any marketplace for that matter. Now, what I'm watching for is the September 4th BOC announcement. That is where the language of what they're doing is really going to matter more than anything else. September 6th, I'm looking for the employment data for the future, which is interesting because they might just sit on their hands again on September 4th, waiting for that employment data. But I'm really looking for the US economic data more than the Canadian, which is crazy from a Canadian real estate podcast. Now, with all this information, this was a data heavy podcast. So I hope you enjoyed a lot of this information. My feedback moving forward is that if you are looking to get into this marketplace, recommend modeling your scenarios. Don't wait. If you're a buyer, understand the regional value of your area that you're buying. This won't last forever. And just generally, I hope you understand how much the US is having an impact on Canadian real estate. Now, this was a bit of a different episode, a lot more data. If you found it helpful, give me a thumbs up, give me a great rating on Spotify, or send me a message on Instagram at themortgagepug or at Flow Mortgage Co. And I'd love to hear your feedback. Let me know so I can add more value to the next one. Thank you. See you next time.